So following on from the live webinar week 1, we're now going to continue on the slide deck looking at group accounting and particularly the consolidated statement of financial position. So we finished off the live webinar looking at how to calculate goodwill. And we calculated goodwill for the in-class example, which looks at parent plus sub and how to get the group statement of financial position. What I want you to go on now, and we did a little poll in class to finish off, do your question 1, which should have a positive goodwill, and deal question 2, which is negative goodwill, which is also known as gain from bargain purchase. So both of those questions are available in the question pack, and they cover not only the journal entries, but how to talk about the consolidated statement of financial position as well, in terms of the steps to go through and what a finished product should look like. So these are just basic steps at the very start. And what we're going to move on to now is we're going to complicate things slightly by saying, well, if we don't acquire 100% of the subsidiary, how do we deal with a non-controlling interest? And after that, we'll deal with fair value adjustments, and we deal with what happens after the acquisition date, which we call the post-acquisition period. So the first complication we're going to look at is, well, non-controlling interest. This NCI concept we've introduced from IFRS 10. Because if you're a parent, you may not purchase 100% of the ordinary share capital. Remember, control doesn't mean full ownership. You can still have control and only purchase 80%, for example. The remaining percentage that you don't own is called an NCI, which is held by third parties. So remember the logic here. If we have control, this is a subsidiary, and under IFRS 10, the subsidiary accounting or treatment is full consolidation. So all of the assets and liabilities are added together, the parent plus all the assets and liabilities. You don't multiply by 80%, you put 100% of them in. But that may be misleading on its own, because of course the group doesn't own 100% of the subsidiary. So what they do instead is they value that 20% that they don't own, as an example, and they call it NCI, non-controlling interest. And that will be shown in the equity section of the statement of financial position. So instead of going through all the assets and liabilities of the subsidiary and taking 80% of each one, the whole approach to consolidated accounting is you bring in everything, all the revenue, all the expenses, all the assets and all liabilities, and you account for the fact that you may not own all of it by creating a single line called the non-controlling interest. So we have to initially value that non-controlling interest at the date of acquisition. We have to create it, because when you bring in all those assets and liabilities at that date, you have to create this NCI as well. And we said in IFRS 3, there's 2 ways to value the NCI at acquisition. And we'll deal with both of those in the next couple of weeks. But as well as that post-acquisition, so once you acquire a business, every period after acquisition, the NCI is going to get a share of reserves. So a share of profits through retained earnings and a share of any other comprehensive income, like revaluation reserve. So the NCI would include ordinary share capital, any share premium, any retained earnings, and any other reserves like a revaluation surplus, based on their ownership percentage. So if they own 20%, they get 20% of share premium, 20% of retained earnings, etc. Preference shares is a bit more complicated, that the subsidiary may have preference shares, but remember, preference shares are separate to ordinary shares. So you could have an NCI that has 30% of the preference shares, but has 20% of the ordinary share capital. So watch that in some questions. We will deal with that in later sessions, but it can be a bit more complicated for exam level questions, where if there's preference shares in a subsidiary, that the ownership split between the parent and the NCI may be slightly different than what the ordinary share capital split is. For determining control and determining whether it's a subsidiary or not, you always use the ownership of the ordinary shares. That will dictate whether it's a subsidiary or not. Owner preference shares, that's slightly different, and we'll deal with that in subsequent weeks. Any ownership of debentures or loan stock or debt, that's not included in NCI. That is not part of the equity section, and that will be dealt with as an intergroup balance, and we'll deal with that on week 3 and week 4. Right? So just bear that in mind. Anything to do with debt or loan stock or debentures is not part of valuing the NCI, because that is an intergroup balance between the parent and the subsidiary, and they'll be offset against each other. Likewise, the NCI can include a part of the goodwill. This depends on how the NCI is valued. We'll deal with that in subsequent sessions, dealing with advanced IFRS 3. For now, we're taking a very basic approach to valuing the NCI, but there is an alternative one allowed in IFRS 3, which we'll deal with next week when we talk about advanced IFRS 3. So just showing you how the NCI is presented. We're taking this from the CRH annual report, which is up on Loop. It'll be a single line in the consolidated statement of profit or loss, profit attributable to NCI. So you split the profit out, the total profit for the group, between the parent, which is often known as the equity holders of the company, and the NCI. So the NCI is entitled to its share of profits. And you'll also have a single line in the statement of financial position in the equity section for NCI as well. So what you're seeing there is, although we have all the assets and liabilities added together, some portion of that is owned outside the group. And instead of adjusting every single line item, we value that interest and we put it in the equity section, and we call that NCI. So similar to what I've given you for Goodwill, I've given you a little template of how you might value NCI at the year end. Now there's a huge amount of things going on here that we won't have covered yet. The only thing we're interested in initially is how to measure the NCI at acquisition, right, under IFRS 3. Everything in terms of post-acquisition profits, post-acquisition revaluation gains, impairments, or these things called unrealized profits, they will come with time. So this is the finished kind of template that you'll be using when you get in 12 weeks time and you're studying exam questions. But for now, it's no harm to see it, to know that there is a template there to help you along, and you'll build up that knowledge over the next couple of weeks as well. So accounting for the NCI, we start off with valuing it at acquisition. There's two methods in IFRS 3. We're going to focus on method 1 for now, which is its share of net assets. So you value the net assets and you allocate the NCI its share. So if it owns 20%, you take 20% of net assets and you value the NCI at that method. There is another method, method 2, which is often called the full goodwill method, where you actually get a value. You value what the shareholding is. So what's the value of 20% of a subsidiary? And you use the fair value to account for it. Now, method 2 we'll deal with next week when we'll deal with advanced IFRS 3. It's a bit more of a step up. For now, we're just worried about method 1. If there is an NCI, you get the value of net assets at the acquisition date and you take the relevant percentage shareholding. So if the NCI is 10%, you multiply net assets by 10%. What this one is called is the partial goodwill method. There's only goodwill attached to the parent's share. If you're valuing the NCI using method 1, there's no goodwill attached to the NCI. And I'll show you that in the example we're going to do now. So we're taking a similar example to what we've looked at before, parent and subsidiary, but now we have a bit of a change in scenario. Now the investment in this is only 80%. So they've only bought 80%. However, that still means control, because you've over 50% and there's no information to negate the assumption that you control the subsidiary. So it is a subsidiary. That means all the assets and all the liabilities are going to be consolidated. But let's have a look now, and we'll bring it Excel here. Let's have a look at how we're going to measure goodwill. So the goodwill calculation here, you're going to look at your investment, and you're going to look at the NCI, and then we're going to look at net assets at acquisition. So the investment, we know we paid 80, and that is getting an 80% share. The NCI, we don't know what a measure is, they don't tell us, but we're using method 1. So how you measure the NCI at acquisition is you get the net assets, which are 100, because we're told the date of the statement of financial position is the date of acquisition. So it's going to be 100 times 20%. So the NCI is going to be worth 20. So you're valuing the whole thing, the 100% share, at €100. And your net assets at acquisition, similar to the previous example, in this case are 100 as well, which is the 30 plus the 70. Your ordinary share capital and retained earnings at the date of acquisition. So that actually means here, goodwill is 0. How you're valuing it is the exact same as what you're getting. So there's no goodwill. Well, that's important that you understand that. How we got the NCI, there is an NCI because you're bringing in 100%, but you actually only own 80%. So you're valuing the other 20% holding, which is not belonging to the group, is going to be called a non-controlling interest. And you measure that at its share, 20%, of the net assets at acquisition. So what would the debits and credits look like there? Well, the debits and credits would look like you get rid of the investment to say that investment is no longer relevant. When we prepare group accounts, we take out the investment and you bring in the subsidiary. What we'll usually show here is we get rid of ordinary share capital and you debit retained earnings, 30 and 70. That's the easier way to do this, is you assume they're added together already. And what you do then is you eliminate what you don't need. You take out the investment, should no longer be there, and the ordinary share capital of the subsidiary should never be there, and any retained earnings at the acquisition date of the subsidiary should not be there as well. Right? But that leaves us unbalanced. We have now 100 on the debit side, but only 80 on the credit, and then we create an NCI of 20. And that makes us 100 on the debit side, 100 on the credit side. So that's a step up than what we're used to before now. We're creating an NCI for the first time. All right. That's important that you practice that. You go back over these examples now, and there will be a question pack on NCI as well, understanding. So what we do is we calculate the goodwill. Investment plus NCI gets us the value of the overall entity, and then you value the net assets of that entity as well. And they happen to be the same. That doesn't always work. Your debits and credits, you have two choices. You can do individual assets and liabilities, assuming you're adding incrementally to the parent's accounts, or the one I would always tell students to go with is this approach. You assume P and S have been added together already, and you merely eliminate or bring in what you need to do. So in this case, we're eliminating ordinary share capital and retained earnings in the sub. We're eliminating the investment in the subsidiary from the parent's accounts. All of them should be taken away. And the new thing we're creating for the first time is an NCI. This approach will always work. This approach will only work when you have a statement of financial position at the acquisition date. And that's rare when you move on to exam standard questions. So I would stick with that approach if you can. To finish it then, to look at a statement of financial position, what you do is you do parent plus subsidiary and then your adjustments. And that's the adjustments we've just done in debit and credit form. You get rid of the investment because that will no longer be there. It'll be double counting because you've brought in the subsidiary. You get rid of the share capital of the sub. That's never left in. And you get rid of any retained earnings in the sub at the acquisition date. Because this statement of financial position is at the acquisition date, all of those retained earnings are what we call pre-acquisition. So they all go towards the goodwill calculation. And you'll see a new line created for the first time, NCI. And that is our credit the NCI because it is in the equity section. And when you credit the equity section, you're increasing equity. That's why the NCI is positive there. The NCI can never be negative. It'll always be a positive figure. So hopefully that makes sense to students. It's just a small step up. We're bringing in the full amount of the assets. You're still adding 100, even though you only own 80% of the company. You're still bringing in the 50. You're still bringing in the 20 and the 30. You don't adjust for the 80% there. How you acknowledge that you don't own the full subsidiary is you create an NCI. And that's where it shows up there. Right? So you can have a look at CRH as one good example of an acquisition where they had an NCI, but the NCI is created at the date of acquisition and it becomes a credit balance in your equity section. Right, so when you're happy with that, go back over that worked example in the notes and then go on and see can you do question 3 in your question pack. Question 3 looks at an NCI example. Just again hammering home what the key journal entries are and see can you do the basic calculations as well. Right. So that's another complication we're adding on. So hopefully this is a refresher for a lot of you, but if it's not, go back to the textbooks that I suggested. All of them are available in ebook format to help you along. So our next complication we're going to look at now is the whole idea of book versus fair value. Right? One key rule when you're doing acquisition accounting, if we go back up here and we look at the steps which we're told for, one of the steps is you need to get the fair value of assets at the date of acquisition. So it's not the book value. We need to know what's the fair value of assets and liabilities of the subsidiary at the date of acquisition. Right? So sometimes that will mean if the assets aren't fair valued in the subsidiary's accounts, you will need to fair value them as a consolidation adjustment. So when you're bringing those subsidiary assets and liabilities into the group accounts at the date of acquisition, you may have what we call a fair value adjustment, which means you need to increase or decrease particular assets or liabilities, and that will impact your goodwill calculation. Because if your fair value of assets or liabilities goes up or down, your goodwill goes up or down as well. So the typical journal entry would be there. For example, increase property, plant and equipment if it's a fair value adjustment upwards. Credit the revaluation reserve. Now we would usually just credit goodwill working directly, because if you're increasing the reval reserve, you're going to be impacting the goodwill working. And we'll see with that the example we're going to look at in a second. If there's a deferred tax liability mentioned in the question, by all means include it. If there's no mention of deferred tax liability, you can ignore it and you'll just do the first two entries. But the whole reason you will have debits and credits like that, or a fair value adjustment, is there's a rule in IFRS 3 that you must fair value all the subsidiaries' assets and liabilities at the acquisition date. So this adjustment should be carried out before goodwill. So before you do the goodwill calculation, you calculate what the fair value adjustment is, because that will impact what the debit and credit will be then overall for your goodwill. This is one possible set of journals that you can give. Right? This is only possible if you have the statement of financial position, i.e. the individual assets and liabilities of the subsidiary at the date of acquisition. If not, we'll be doing the more straightforward approach, which is this one here, where you're removing ordinary share capital and retained earnings instead, because that will work no matter what date you have the statement of financial position at. And look, that will make more sense as you go through more detailed questions in the coming weeks. So don't worry too much about it for now. These are types of journals. Just understand they can be presented differently. So let's take a small example of book versus fair value, and we'll see how the debits and credits work out. So in this example here, we're given the subsidiary's balance sheet at the date of acquisition. So we're not given the parent, so we're not doing a full statement of financial position. We're just worried about the debits and credits here. So you're told the subsidiary here, its book value is, if you look at it, 5.1 million. So the net assets, 6.8, minus the liabilities, 6.8 minus 1.7 is 5.1. The easier way to look at that is just look at ordinary share capital plus retained earnings. That gets you net assets as well, and often that's a quicker way of looking at it. 5.1 million is the book value at the date of acquisition. And you're told the parent acquires 80% of the subsidiary for 4.8 million. So you're going to have an NCI here as well. At the date of acquisition, the carrying value of net assets equal their fair value except for PP, which is a fair value of 5 million. So that means this is understating the true fair value of property, plant and equipment. So what we're going to need to do is bring that up by 400,000. Right? So how we do this, and we'll look at it from a calculation perspective first, and then we'll look at debits and credits. The investment here is 4.8 million. So we'll just do it out full figures just to make it easier to follow. 4.8 million. We'll drop off the last 3 zeros just to be consistent with the slides. Then you have an NCI. We don't know what it is, but we know it's 20%. Because if the parent acquired 80%, you have an NCI for 20%. Then you get the fair value of net assets at acquisition. The book value is 5.1 million. That's coming from the statement of financial position, which we're given, but we know that's understating property by 400,000. So what we call that is a fair value adjustment, 400. So that means the fair value of net assets, not the book value, the fair value at the date of acquisition is 5.5 million. And you use that to value your NCI. So that will be 1.1 million, which is 20% times 5.5 million. So you see the way you have to figure out what the overall value of the net assets are. And then method 1 of valuing the NCI, we'll deal with method 2 next week. Method 1 is said, we'll take the ownership percentage of that. Take the 20% times the 5.5. So we're not saying it's an extra 5 million. We're saying the fair value is 5 million. So if the book value is 4.6, you're essentially increasing about 400,000. So that would be debit the property, plant and equipment and credit a reval reserve. Or you can just credit goodwill working directly, because the higher the fair value adjustment is, the lower goodwill is. So your goodwill there will be investment plus the NCI, which gets us to 5.9 compared to the 5.5. So your goodwill is 400,000. Now remember, if I didn't have the fair value adjustment, my goodwill would actually be 800, because I'm comparing 5.9, which doesn't change, to 5.1. So by having a fair value adjustment in there, it actually reduces my goodwill working. So sometimes you might see a debit and credit for the fair value adjustment to be debit PP 400, credit goodwill working. Credit goodwill 400. Now, if you've seen that, that's fine. That's the right answer as well. That's just the individual journal entry for a fair value adjustment. Increase property, plant and equipment from 4.6 up to 5 million, i.e. 400, and reduce the goodwill, because goodwill is reduced down by having a fair value adjustment there. So that's a valid answer to do. If we're doing the overall journals for goodwill together, one alternative is the one that's given in the slides. Right, so this is how you calculate it out. But one alternative here is to do the individual assets and the individual liabilities, because we have all of them. So bring in the asset at its 5 million, including the fair value adjustment. Bring in the subs current assets. Bring in the subs current liabilities. Get rid of the investment from the parent, and recognize your goodwill and recognize your NCI for the first time. So that is a viable one. That only works when you have a statement of financial position at the acquisition date. So you know exactly what your subsidiaries' assets and liabilities are. Often an exam question you won't. So an alternative debit and credit, which will get you full marks, and it's actually a bit easier, is this. You get rid of the investment, which is, just double check here, 4.8. You create the NCI for the first time, 1.1. You bring in goodwill, which is 400. And what you do instead is you will debit ordinary share capital and debit retained earnings at the acquisition date, which in our case, you get rid of the ordinary share capital, 2.5, and you get rid of retained earnings, 2.6. So that's an easier way to do it, where you're assuming that the parent and the sub have already been added together, and now you're removing what shouldn't be there or bringing in items that should be there, the NCI and the goodwill. So you don't have to do both sets of journals, either this, if it's possible, or these are for full marks. I'm a big fan of this one because it works in every exam question. What you'll notice here, it doesn't balance. 5.9 on the credit, 5.5 on the debit. You actually have to debit PP here 400, because you're saying it's understated. Remember, these journals assume that the statement of financial position has already been added together, so you're only making the incremental adjustments. This assumption here is nothing has been done, so you're starting from scratch and bringing everything relevant for the subsidiary in. So it's just, they're two different sets of journals with different assumptions. One assumes the subsidiary has already been added in, and you're just making the adjustments. Another assumes nothing has been brought in and you're starting from scratch. Right? I prefer if students focused on this one, because this will be applicable to every exam question you get, no matter what the dates are. Right? So we see we're stepping up now, we're bringing it together, and there's a good bit in it. So it's important that you can bring these together and you understand what the key aspects are. Right? So I want you now to pause this and go on and look at question 4 in the pack, which looks at book versus fair value and how to complete a fair value adjustment. That'll give you a good idea of how to approach a question like this. Right? Okay, so our final main complication. We're building up the basics of a consolidated statement of financial position and how to deal with it is post-acquisition. What happens when we acquire a subsidiary after the date of acquisition? In the previous examples we've looked at with goodwill, NCI and fair value adjustments, we've only ever got to the date of acquisition. We haven't really considered the periods post-acquisition. What happens when you make a profit? When a subsidiary makes a profit, it has to be split between the parent and the NCI based on their ownership percentage. So it's not about just calculating goodwill. That's at a point in time. You then own that subsidiary for periods after the acquisition date, which we call in group accounting the post-acquisition period. And then all profits or losses that a subsidiary makes post-acquisition, that will be allocated based on the ownership percentage. So that distinction between pre-acquisition profits and post-acquisition is quite important. Anything pre-acquisition for retained earnings, for revaluation reserve, that goes to the goodwill calculation or the valuation of the NCI. Post-acquisition, that will go to consolidated retained earnings or group retained earnings for the group's share. So any profits, their share of profits in the subsidiary after the date of acquisition increases group retained earnings. Any post-acquisition profits belonging to the NCI, their share, that goes to increasing the NCI. So once the acquisition date is finished, goodwill is not impacted by post-acquisition profits. It's either group retained earnings or the NCI themselves. And that's stepping up now. We're getting a bit more advanced again, moving towards the exam level questions that you would have done in your undergraduate module. Right? So this is the key, again, template you're looking for, group retained earnings. So how do we calculate retained earnings? One where there's one of the biggest marks we'll be going for in any consolidation question because there's a lot of adjustments. For now, there's a huge amount there. The only things you want to note is to calculate group retained earnings, otherwise known as consolidated retained earnings, you start with the parent. What's the parent's retained earnings at the year end? And to that, you add their share of subsidiary post-acquisition profits. That's your key one we're interested in now. Don't worry about all these adjustments. They will come over the next couple of weeks when we're dealing with intergroup adjustments. But for now, your starting point for group retained earnings is what the parent retained earnings are, because they are a core part of the group. To that then you add what is the parent's share of post-acquisition profits, not the full retained earnings of the subsidiary, only the amount of earnings they've made since the date of acquisition. Any retained earnings before the date of acquisition would go to the goodwill working and the NCI. You're only worried about this thing called post-acquisition. And that's an important distinction you have to start getting practice on. And that will also work if you're doing, for example, revaluation reserve. It's the parent's reval reserve plus their share of post-acquisition revaluation gains or losses in the subsidiary. So we are layering on a lot now, and it'll take a bit of practice. That's why I want you to go back to that question pack 1 and do question 1 to 6 as well. So take this example. Right, we started parent P&S before, but we're now looking at it slightly differently. We're given the statement of financial position, be careful, at the year end, 31st of December 2015. However, the acquisition date was the 1st of January. So you actually don't have the statement of financial position for the sub at the acquisition date. But we can still do our goodwill calculation because we know what retained earnings were at the date of acquisition. So if we know what retained earnings were at the date of acquisition and we know what the share capital was, that means we know what net assets were. So we're starting to move on now a bit. So we know the investment was 80, and that was 80% because we're told it here in the question. We know if that 80 is in the parent's accounts, that was the adjustment under IAS 27. The parent on the 1st of January, when they invested in the subsidiary and got 80%, they would have debited investment, credited bank. So we know they paid 80. Goodwill calculation is always done at the date of acquisition only. Then you value the NCI. Now the NCI is going to be worth 20%. We don't know 20% of what yet, because we need to know the fair value of net assets at acquisition. We don't have the individual assets and liabilities. It's wrong to say it's 150 minus 50. The reason for that is this is the statement of financial position 12 months later at the end of December. See, it's complicated now. We need to know the net assets at the date of acquisition. To get that, we use the other way, the shorter way, ordinary share capital, which doesn't change. That would have been 30 at the end of December. It would have been 30 at the start of January 2015. And we know retained earnings. They are not the 70, they are the 40. Retained earnings at the date of acquisition. That's why you're given that in the question, because then you now know the net assets at the date of acquisition are 70. Net assets is the same as equity. We don't know what the individual components are. They weren't 150 and they weren't 30 and 20, but we don't have the statement of financial position. But we don't need it. We only need it at the year end. So the NCI then is going to be 20% times 70. The net asset acquisition date, 70 times 0.2, which is 14. So overall, the 100% holding is going to be valued at 94, and the assets you're getting were worth 70 at the acquisition date. So goodwill here, it's worth more than what the assets you're getting is 24. That's how you approach it. You watch it, particularly this here, you have to get net assets at the acquisition date. It's very rare, if ever, you're going to have an exam question that is going to give you the statement of financial position at the date of acquisition. They're going to give it in a period after then, because you're going to have to make adjustments. So this takes a bit of time to get used to. So we know the goodwill and acquisition is 24. Right? What would the debits and credits for that be? Well, we don't know what the individual PP or current assets were because we don't have it at that date of acquisition. So instead what we say is it would have been debit goodwill, 24. It would have been credit NCI, 14. So you're bringing in the new items that are not currently in the statement of financial position. And you remove the two items that you don't want. You debit ordinary share capital, get rid of the subsidiaries ordinary share capital. That is never left in group accounts. And be careful here, you debit retained earnings 40. You don't get rid of the full 70, you only get rid of 40. So that is here 94 on the debit side. You have only 14 on the credit side because we need to get rid of the investment. Credit investment 80. So you've gotten rid of three things and you've brought in two things that are unique to the group accounts, goodwill and an NCI. So I want to draw your attention back now. What's going on with this 70? This retained earnings is 70. This retained earnings of sub at the 31st of 12th is 70. That's made up of what we call pre-acquisition retained earnings, which are 40, and post-acquisition retained earnings, which are 30, because 40 minus 70 is 30. So this 40 goes to the goodwill calculation, like I set up here, goodwill and value in the NCI. The other 30, that's post-acquisition. That is going to be split between group retained earnings, 80%, and NCI, 20%. Right? So that's an important, and this is what we're focusing on this particular aspect is, when the subsidiary makes profits after the date of acquisition, in this case it's a nice neat 12 months since the date of acquisition, you split it in according to the ownership. The group, through group retained earnings, will get 24, and the NCI, through the NCI, will get 6, i.e. 20%. So that's important that you understand where those calculations are coming from. So you have a second step that when you do the goodwill calculation, that's the first step. Then you're thinking, well, what happened since the date of acquisition? This 70 now, you're splitting it between group retained earnings, the parent's share, and NCI, the NCI share. So if we're thinking about it, what will the consolidated statement of financial position look like at the year end? Well, group retained earnings, go back to your little formula that I've given you, your little template. It's the parent retained earnings plus the parent's share of post-acquisition profits. We haven't dealt with any of these adjustments yet. Park them for now. We will get to them. Parent retained earnings. Go back to the question. We know the parent retained earnings here are 240 at the year end. That's nothing to do with the NCI. That's the parent on their own, 240. And then you have the share of post-acquisition profits. I call it PAP for short. That is 24. That is coming from up here. So group retained earnings at the year end, you'll usually do a working for this. It'll be 264. Right, so that's where it's coming from there. Just show the this one here, 240 plus the share of post-acquisition profits. The NCI at the year end is made up of the initial value, which was 14. Coming back from up here, we initially valued the NCI in January at 14, and now their share of post-acquisition profits is 6. And that 6 is coming from up here. So you can see the 30 is divvied out. We've got rid of that 70. 40 has got rid against the goodwill calculation. That's been debited, got rid of. The remaining 30, that's going to be shared between the group retained earnings, who get 80%, and the NCI, who gets 20%. So the closing NCI at the year end, which you're going to have in your group financial statements, is 20. And I would always take that approach anymore. Don't try and do a column or structure like you see here. Now it's fine for 1 or 2 for doing a column or structure, but when you get to more exam level questions, you won't be able to fit all the adjustments in group retained earnings. You won't be able to fit all the adjustments in NCI. It's better to call them working 1 or working 2 because you'll have a lot more adjustments going on. But similarly, to finish it off, it's parent plus sub. Remember, this is the parent's financial statements at the year end. This is the sub's financial statements at the year end. So you can logically add them together. You remove the investment, you bring in the goodwill, and you bring in the NCI. Now we're bringing them in at the year end. Sometimes students like to show the different adjustments blow by blow. That's fine for little simple examples like this. When you start going on to longer exam questions, you're better off taking it off, putting it as a separate working, and just slotting in the final figure, the 264 there, and the 20 there. And that's where all the marks are going for. In a consol question, there's a huge bulk of marks going for calculating goodwill, calculating group retained earnings, and calculating NCI, because that's where the majority of the adjustments are as well. So make sure you go back and practice those. I have another question, and there should be a question there in the question pack on date of acquisition. So go back and look at question 5. So what you'll have done when you finish that then is you'll have a question on each of the individual aspects done. And you'll have good practice then of the key basics of how to prepare a consolidated statement of financial position. Right? And what I want you to do at the very end then is you bring it all together. And I want you to do question 6. So try and have that done by the next day now. Question 6 is a full consolidated statement of financial position. But what I like about it is it's bringing everything together. You're going to have an NCI because the parent didn't acquire the full amount of the shares of Jerry. You're going to have a fair value adjustment, which means you're going to have to make an adjustment to the subsidiaries' land or buildings because they're undervalued. And you're going to have post-acquisition period because the acquisition date was the 1st of January 2015, but you were asked to prepare the statement of financial position 12 months later at the end of 2015. So question 6 should really be done at the end when you bring everything else together and you're looking at all 3 or 4 adjustments, an NCI, a fair value adjustment, and post-acquisition period all together. And hopefully you'll have a good grasp of that by the time we come to the week 2 live webinar. All right. So your key takeaways then on your basic consolidation, first thing is to check, is there control? If it is control, now that is outright control singly, not joint control, that's separately completely. That's a joint arrangement. You're then going to prepare the group accounts as if it was a single entity, i.e. add everything together. Your first step is IFRS 3. You figure out how much you paid, You figure out the assets and liabilities of the subsidiary, and you value the NCI. And that will get you whether it's a positive goodwill or negative goodwill is often called a gain from bargain purchase. We have just looked at the basics of IFRS 3 this week. There is another section we're going to look at next week and the week after called Advanced IFRS 3, where we look at different things that can come up, more complicated areas, and that's the step up from undergrad to masters as well. But you need to start knowing your journals. There's going to be a big emphasis on journal entries in your end of semester exam in May, so it's important you know consolidation journals as well. For now, it'll be tricky until you start building up your knowledge, but try and keep a follow of it. Don't just try and learn off calculations, think about the journal entries as well. All right? So again, we've talked much about that. We won't dwell on it too much, but in preparing, the main adjustment you're going to be looking at is you're going to be taking that investment and subsidiary line in the parent's accounts, and you're going to be offsetting it against the equity and the retained earnings at the date of acquisition. If there's a surplus left over, that's goodwill, it's positive, and it's going to be an asset. If it's a negative, meaning you paid less than what you got, that's going to be a gain from bargain purchase. And that gain from bargain purchase would actually be a profit. It would be a credit and increase retained earnings. So they're treated differently depending on whether it's positive goodwill or whether it's a gain from bargain purchase. So that just kind of gives you a summary of the key standards. Really, in this session, we've only scratched the surface. We've looked at IFRS 3, the basics of it, and we've looked at IFRS 10, which gives you the framework for consolidated accounting. Over the next 12 weeks, we're going to look at all the rest of the standards as well. IFRS 11, joint arrangements, associates, foreign subsidiaries. So please bear in mind, I'm no like a broken record here, try and keep up with week 1 to 5. If you can get to reading week and you're well up to speed, you're doing the exercises, you're watching the pre-recorded material, you'll be well prepared for what comes after reading week, which is the more complicated and trickier areas in consolidated accounting. Right? So hopefully you'll find that in terms of your key takeaways in this first section for week 1. It's really understanding the key types of investments: subsidiary, associate, joint arrangement, and simple investment, and particularly now how to deal with a subsidiary, initial goodwill calculations, dealing with NCI, and dealing with that post-acquisition period. What I want you to have done now for week 2 before the live webinar is go back over this material number 1 and attempt question 1 to 6 in the statement of financial position. The solution pack for 1 to 6 are up there. 7 to 10 will be for next week when we start looking at consolidated statement of profit and loss and a consolidated statement of changes in equity as well. The other thing I want you to think about before next week as well is just access some of those ebooks online. Whether it's the basic one, the Mahoney McLaughlin textbook, or whether you want a bit more of an advanced textbook, Conley or Elliott and Elliott, they should all be available in ebook format. If you have any trouble in that, just get in contact with me and I'll help you along. Other than that, I will see you in week 2 for our live webinar again.